Oh boy, dear students, we are going to attempt to do the impossible. And that is to get our arms around this 800-pound marshmallow that is the mutual fund industry. In less than an hour, I promise, we'll go through the major categories, the major types, the major categories of mutual funds. Major, yeah, I'm not thinking of another word for categories, but that's the word I'm thinking of. Categories, types, and the like. Because there are dozens, and you can't remember them all. I certainly can't. But this presentation will discuss the most important ones. And then what you'll find is that there are subcategories and subcategories and boutique funds and all kinds of exotic things that are really not as important for the vast majority of us prudent, long-term oriented investors. And what we're going to do is we're going to go from the most aggressive, the most hard charging, risky funds to the least riskiest. Now, on the board in the face-to-face class, we would construct what I call the mutual fund scramble sheet. And of course, we're not in a classroom setting. So in the website, on the class website and Canvas, you'll see a document called the Mutual Funds Types Scramble Sheet. And there's a commentary. I hope you'll print this thing out. It's quite involved. The DSS people don't really like it when we draw stuff like this. They say it's very difficult for people who are using readers. Well, actually, it's impossible because it's all drawn. The only problem is I've tried using I think Adobe Illustrator and other programs to sort of capture what I did here drawing wise, and I'm not very good at graphics. In fact, I'm pretty bad. So if any of you are excited about this material and also are savvy with graphics, please contact me because I could use some help. So print this thing out because we're going to go through the whole thing, the whole scramble sheet in this presentation. It's a good idea to have it. So stop the presentation. Come on, print it out now. Good. Okay, glad to hear that you've done that. All right, so we're going to start with the most aggressive stock funds because, of course, stocks are much more volatile than bonds, which are more volatile than money market mutual funds, short-term investments. So I don't know if this is going to help. This analogy, this metaphor, I use it. I like to think of it this way. It's up to you. I like to think of a buffet because I love to eat. And so when you go to a buffet, do you load up your plate with just one thing? Well, I guess maybe some people do, but no. If you have a 401k or a Roth IRA or just a regular account, you might pick a few mutual funds, depending on how much money you have. If you're just putting away $50 a month, just pick one until you get about, a few $1,000 or 5,000. It's very subjective and variable from person to person. But then when you have a goodly amount in a core, sometimes use the word core fund, then you could start putting more money in others. Of course, if you have a 401k, they're very sophisticated and you can put $10 in one, $20 in another, $30 in another, and the system takes care of all that for you. So the very first, the most aggressive type of fund are aggressive growth stock funds. Highly speculative. Remember what we know to use when we see the word speculation or speculative? Gambling, right? They seek large profits from capital gains. They're rolling the dice, folks. It's a very, very risky, typically will be a very risky mutual fund. It will be a roller coaster. And actually, some funds have a category 1 or 2 times more speculative than aggressive growth. You'll see the word ultra or momentum funds. There was one called Janus 20. It's gone now. They buried the evidence. But if you remember back in our very first presentation on mutual funds, we said that every mutual fund must not put more than 5% of their assets into any one investment, which means the law is basically making them have at least 20 different investments, 20 different stocks or 20 different bonds or whatever. So we, on the other hand, like to see 100 or 150 or maybe not that many. It depends on your risk tolerance, but diversification is a good thing. If you concentrate, it may work out well for you. In fact, it does for some people, and it doesn't for a whole lot more. And it worked out great for Janus 20. You see, Janus 20, we're only going to have 20 stocks. And this was during the internet boom and then subsequent bust. And Janus 20 looked like geniuses until they didn't. If you live by the sword, you die by the sword. And eventually they rolled it into another fund called Janus 40. They didn't learn the lesson, did they? But what can we say about aggressive growth funds? Well, they're the jalapeno peppers. They're the spice. They're the hot chilies that can make our dish just really exciting, but also burn us. And when you go to the buffet table, do you fill up your plate with jalapeno peppers? I don't think so. Maybe a few people do. And so maybe a few people just want the aggressive growth funds. And what happens is they'll look at the documents or the online materials, and they'll see that this aggressive growth fund just beat everybody else over the last 10, 20 years or whatever. And sure, we're going to have high returns typically, but are they ready? Do they understand the risk involved? Do they understand that there were 3 times when it dropped 40, 50%? And are you willing to hang on when it drops 50%? Exactly. So put a little bit on your plate, okay? Put a little bit of spice on your plate. And if that helps, great. If it doesn't, no big deal. Now, the next category are growth funds. Growth funds are mutual funds whose primary goal are capital gains and long-term growth. And so they will typically invest in high growth companies. They will look for companies that are growing very fast. And of course, we all know these companies are the companies that are featured in the news. They're on the cover of GQ and Vogue and Vanity Unfair. They've got beautiful teeth and gorgeous hair. And you know I'm talking about, now Netflix and Amazon and Farcebook, Fleecebook, whatever it's called, Beta, Zeta, Grady. And so Apple, these are going to have better returns, but they're also going to be very, very volatile. Just recently, Netflix dropped like a stone. But if you go back in time, you find that it's happened like 4 times in the last 20 some odd years. So, or maybe more, I don't really remember. So you understand that these two categories are going to be very volatile. But if you have a long-term perspective and you're willing to put up with the volatility, meaning it went down 30, 40%, they should do very well for you over the long term. But don't load up your entire plate with these things. Maybe 10% aggressive, 10, 20% growth fund. It's up to you, of course. The next category, and this is where it starts to get pretty strange, are called capital appreciation funds. These are mutual funds that seek long-term growth of capital. Well, wait a minute, Payano. I'm confused already. I don't blame you. How does this differ from a growth fund? Well, most growth funds in the prospectus will have a provision that states they will invest primarily in growth stocks, usually staying between 80% and 100% invested in the market. That's the verbiage you'll see in the prospectus that nobody reads. But capital appreciation funds, on the other hand, can often invest in anything they like, anywhere they like. They don't have to invest just in growth companies. They could invest in what are sometimes called value companies, and we'll discuss growth versus value in the next chapter because it means different things to different people. But in other words, instead of the companies that are on the cover of GQ and on the news, they invest in boring companies that they think, are undervalued for whatever reason, and the potential for capital appreciation is there. So I like to think of them as being able to paint with a broader brush. Whereas a growth fund, aggressive growth fund, are going to go after those companies that are growing their earnings quickly. A capital appreciation fund might look at a company that's actually in an industry where it's shrinking. The industry is shrinking. And what happens when that happens is there's often consolidation. So there's the potential for a company to get bigger in a shrinking market. I mean, it's counterintuitive, but it happens. The well-known Fidelity Magellan Fund that was run by Peter Lynch, and he racked up 29% a year, is a capital appreciation fund. And it just worked perfectly for this guy, Peter Lynch. And we'll talk about him later on. We've already mentioned him. He just had this knack for sniffing out value, sniffing out companies that had the potential to go up. And he did very well. So if you look at our Scramble sheet, you'll see that I tried to, this is where it gets tricky, right? I tried to write capital appreciation funds around aggressive growth and growth funds. Because in practice, in general, they tend to be as risky as growth and aggressive growth funds, but not always. So you see what you're up against? And to make matters worse, one of the nation's oldest and most successful growth funds, capital appreciation funds, is called the Growth Fund of America. We looked at it in our previous presentation. And if you went to them and said, well, how come you're not calling yourself the Capital Appreciation Fund of America? They would say, excuse us. We were the Growth Fund of America before this term capital appreciation was even applied to the mutual fund industry. So you see, it's not easy. You have to dig deep. You have to scratch the surface and dig deep into the industry. And as we said, there's 12,000 of these things, so no one person is going to know everything about all the mutual funds. This is impossible. Don't even try. Don't even try. You're going to find the companies that speak to you for whatever reasons, and then you're going to learn as much as you can about them. And, there's plenty of time to look at other companies and maybe invest in them, but sorry, no one person can do it. So now we'll come down the risk versus return rainbow spectrum, and we take a look at the next category, and that's called growth and income. These are mutual funds that seek both long-term growth and current income, typically with a primary emphasis on capital gains, but not always. So you see, before the funds were looking for the spice, we're looking for growth. This fund is looking for growth, yes, we are, but we also want income. And typically that is dividends. Companies, corporations can pay dividends. They don't have to, they're optional. We'll discuss these in detail when we get to stocks, and we've already made mention of that. But sometimes the growth and income fund might decide to buy some bonds to augment the income. And here's again where it starts to get tricky. Some people refer to these as blend funds, a blend of growth and income, you understand? And then some people will refer to them as value funds. But be careful. Value funds, depending on who you talk to and what company you're dealing with, are mutual funds that seek stocks that are undervalued in the market by investing in companies and shares that have low PE multiples and high dividend yields. Or with P, physical education? No, it's price to earnings ratio, and we'll discuss that in detail in next chapter. Again, one of the problems of putting mutual funds before stocks, but there are problems of putting stocks before mutual funds, so we're doing the first one. They often look for companies out of favor with investors. So As we said, some folks will lump the growth and income funds and the value funds together. And if you look at the Scramble sheet, you'll see I put growth and income here, my favorite, and then blend and value sort of around there. Now, what can we liken these funds to in our buffet? This is the main entree, the pasta, the meat and potatoes, the stuff that you're going to put mostly on your plate. In fact, if somebody's just starting out with 25 bucks or 50 bucks a month, I often say go with the growth and income spending. It depends if they're younger, if they're older in the 50s and 60s and 70s, you probably want something more conservative. But if you're young, just starting out, I say, look, let's start with a growth and income fund. Why not, right? Because you get some growth, you get that long-term growth of capital, but you also get income. And when the market dives, as it invariably does, that income will help the growth and income fund not go down as much as that growth fund or that aggressive growth fund. And the same thing is true for the value funds, realizing that they're a little different, but people will lump them in together. Yikes. You see what you're up against? The next category is the least riskiest stock fund. These are all stock funds, and so they're all risky, but the equity income funds are the least risky. And why is that? Because these funds emphasize current income and capital preservation. By investing, you see, capital preservation is a fancy way of saying don't lose the money. By investing primarily in high-yielding, income-producing common stocks, corporations, businesses, boring, railroads, foods, utilities, real estate investment trusts, basically real estate companies. And they may also invest in bonds to generate income when the investment advisor believes that stock prices have risen to levels that threaten the preservation of capital. Do you understand? Look, we want to invest in stocks, but we're not interested in shooting the lights out and skyrocketing. We want to not lose the money. So we're going to invest in companies that are in slow growth industries, that are paying good dividends, that have been paying dividends for decades. Utilities. I mean, how many people want to take a cold shower in the dark? That's not going to happen. But of course, at the same time, the utility is not going to grow at 20, 30, 40%. Many equity income funds did very well during the 2000 to 2002 bear market, after lagging the market badly during the late 1990s bull market. Every type of fund was clobbered in 2008. But in 2008, the growth funds, the aggressive growth funds lost 50, 60, 70%. The growth and income funds lost 40%. The equity, maybe 50%. The equity income funds lost 30, 35%. So you see, it doesn't sound like a lot, but put up some numbers and see $100 goes down to 30. That's painful. Now you have to triple your money to get back to even. $100 goes down to $50. You got to double your money. You got to get 100% return to get back to back even. But $100 goes down to $70 or $68. It's not as painful, and it won't incentivize you, motivate you to jump ship. No more, no more, no more, no more, no more. Yeah, you weren't even born yet. But in the late 1990s, these funds were considered old economy. That was the term that people were using at the time. Old economy. You don't want old economy companies. Not that railroads are going anywhere. You want new economy companies. You want companies like AOL, who, and drcoop.com, and CMGI. The Globe. Do any of these sound from? No, they don't, because they're all. Well, AOL's still around, but it's not what it used to be. So what can we say about equity income funds? Well, they're the oatmeal. Yeah, boring. They're the boring food. But, dear students, boring food is usually very good for you. Eat your spinach. Eat your broccoli. And so it ain't going to burn you. It's not going to make you jump up and down and scream and holler, but it's good for you. And equity income funds, especially for people in their 50s and 60s and even into their 70s, equity income funds are an excellent way to still have some exposure to stocks, but not the most riskiest stocks. Cool. Okay. So that was our from the riskiest to the least riskiest stocks, right? Here they are. From the aggressive growth down to the equity income. Because now we're going to throw another curveball at you. The next stock classification is the size of the company, what's called the capitalization. And we'll discuss market capitalization in detail in the next chapter. But there are three categories: the Papa Bear, the Mama Bear, and the Baby Bear. Large cap, mid cap, small cap. And we're not talking about things you put on your head. These are large companies, the largest companies and the medium-sized companies and the smallest companies. So which one's the riskiest? The smallest companies. They're also going to give us a better return over time, but it's going to be more volatile. The larger companies have the wherewithal to make it through difficult times where the smallest companies get destroyed, right? But medium-sized somewhere in between. But when things go great, smaller companies are more nimble. They can take advantage of new opportunities. And then we're also going to have another classification called the domesticity. Now, do you remember from the first chapter? Very important. Domestic means based inside the United States. International means based outside the United States. And global is everybody. So it used to be, as we discussed, that domestic were the least riskiest, international were the overseas, foreign were the most riskiest. But that's it's not as true anymore. The world is so global these days. So what happens? It winds up, we find that mutual fund companies will pick one from column A, one from column B, and one from column C, and you wind up with a global large cap growth fund or a domestic small cap aggressive growth fund. So you see how the industry was able to produce 12,000 different funds? Because if you go to your statistics professor and ask for the combinations of 5 things and 3 things and 3 things taken one at a time, it's dozens and dozens and dozens and dozens. And then multiply it by the number of companies out there, and you see why we wound up with 12,000 funds. Yeah. Now, another classification is regional. Mutual funds that are based just for Japan or the Far East or Latin America. It used to be, I don't think it's still in existence, but there used to be a fund that just invests in companies based in California. Well, think about it. California, if it were a country, it would be the 5th or 6th largest economy in the world. So not a bad pool to invest in. But I'm not a big fan of these things. I mean, if you know something about the Far East or Latin America or Canada, they're ones that are based just in Canada. Well, I'm not trying to knock Canada, but it's just one country. You're concentrating your portfolio. Think of this as a little bit of spice. If you know you've been down in Latin America and you see that things are really doing well, put a little bit on your plate, 5, 10%. But in general, we buy mutual funds for diversification. We don't want to concentrate because diversification is a good thing for the vast majority of us. Now, there might be some people out there who say, no, I want to be I want to be more risky. I want to roll the dice, and we wish them a lot of luck because they're gonna need it. And the same thing is true now. We have funds that just invest in emerging markets, such as India, Mexico, Brazil, Russia, Philippines, China, Turkey, Eastern Europe, and the like. Africa is booming. But again, we're concentrating. Me, I'm a big global fan. I like funds that invest globally. I want to tell my mutual fund managers, no matter where this company is, I don't care where it's based, go find me the best companies. So I'm not a big fan of these. Doesn't mean you shouldn't do it, but it just means you have to be more careful and willing to accept the risk, because sometimes emerging markets are called submerging markets with good reason. Exactly. And by the way, the emerging markets really weren't anything to be invested in until about the 1980s. There's a cute little story about that. The World Bank wanted to create a fund, a mutual fund, that would invest in the emerging markets. But they didn't call it the emerging markets. They wanted to call it the Third World Fund. One banker, when they were giving this presentation to the investment advisor, the big Mahatmas in New York, he got up and said, look, my job is to not lose my clients' money. So I have no intentions of investing in your fund. But for God's sakes, don't call it the Third World Fund. I wish you a lot of success, but I don't want you to don't call it the Third World Fund. And that's when we started to see developing markets and emerging markets, and the term third world was, put to the side with good reason. Now there are two more categories that I hope you have nothing to do with, and that's sector funds and market timing funds. Now, sector funds, again, if you know something about the energy sector or a certain part of the technology sector, there are a few different sector funds in energy, a few different funds in technology, a few different funds in healthcare. These mutual funds invest just in the companies in that sector: airlines, leisure, telecommunications, basic materials. Again, we're concentrating with a sector fund. If you happen to work in that industry, sure, put a little bit on your plate, 5-10%. But in general, you want broad diversification. Now, what's market timing? Well, it's dumb. These are people who are fooling themselves and hoping to fool you into believing that they know when the market's going to fall and they know when the market's going to rise. And guess what? No one's been able to do it accurately. Plenty of people do it inaccurately, and we don't want you to be one of them. So those were the stock funds. Now we're going to do the same thing with the bond funds, realizing that bond funds are far less volatile than stocks, because bonds are far less than stock funds, because bonds are far less volatile than stocks. These are sometimes called fixed income, right? Bonds are fixed. Mutual funds that invest in various kinds and grades of bonds with income as the primary objective, because bonds pay interest. And we're going to do the same thing. We're going to go from the riskiest to the least riskiest. The riskiest are called high yield bond funds, sometimes high income bond funds. But typically what people refer to them as are junk bond funds. And we'll discuss junk bonds later on when we get to bonds. But these tend to actually follow the stock market more than they do the bond market, and there's a reason for that we'll discuss later on. Again, this is something that you don't typically want on your plate. If you do, just a little bit in your plate. But the next category are the high quality corporate bond funds. These are the companies that you've heard of. Many of you haven't, but typically large companies, because small companies, they have a harder time selling bonds. They usually get their funding through stocks or from venture capitalists. And then there are actually convertible bond funds. These are bonds that can be converted into stocks. Sounds exciting, but it really isn't. We'll stay away from it until we discuss bonds in detail in several weeks. The next category are municipal or insured municipal bond funds. These are state and local governments, the city of Chula Vista, Southwestern Community College, state of California, or any state. And they're very popular with high net worth individuals. And why is that? Because the feds can't tax the states can't tax the feds. So when you have a bond that is a municipal bond, doesn't matter which state it is in, doesn't matter, you do not have to pay income tax on the interest. Now, there's some exceptions that we won't get into. We'll talk about it later. But in general, they're free from federal income tax. Oh, by the way, the IRS doesn't like the word tax-free. They want you to use tax-exempt. Oh, okay. And if you buy a bond in your state, and for us, that's California. If you buy a California bond, doesn't matter where it is, a school district, a hospital, a water authority, or a city, county, or the state itself, you also do not pay any state taxes. Why is that? Because the state is trying to incentivize you to buy the bonds in their state. So they're saying, hey, look, we're not going to tax you. So these things are very popular with people who have high tax bills. Okay? And then the least riskiest of bond funds are the U.S.-backed and the government bonds. Now, these are U.S.-backed bonds are not specifically backed by the United States government until the organic matter hits the ventilating device, and that's when the U.S. government steps in, and that's what happened in the Great Recession in 2008. So you might have heard of Fannie Mae and Freddie Mac, and we'll discuss these in detail later on. But these are bonds that are backed typically by mortgages or maybe student loans. And the U.S. government, even though they said up until 2008 they would never step in and save Fannie Mae and Freddie Mac until they had to, and everybody in the world believed that they would, and they were right because they did. We did. You are now proud owners of Fannie Mae and Freddie Mac, believe it or not, as taxpayers of the United States government. And then the granddaddy of them all is the government bonds, treasury bonds. Notice the feds can't tax the states can't tax the feds. So the income, the interest income from a government bond is actually free from state and local taxes. Now the Treasury, the IRS, still charges you taxes on the interest you receive from a government bond. They don't do the same thing the states do, but you don't have to pay California taxes for us California residents. So again, in the Scramble sheet, you see the same kind of idea. We've gone from the most riskiest to the least riskiest of bonds. And then we're going to do the same thing we did with stocks. We're going to overlay two other categories. The global, domestic, international, that's the same. That's basically the same idea. Is it a global bond fund? Is it a domestic bond fund? Is it overseas? But this one's a little tricky because long, short, large, and small, right? They have the same letter. And then intermediate is kind of like mid. So you might think that long-term, intermediate term, and short-term are similar to the large cap, mid cap, small cap that we talked about in stocks. No, not at all. They're two different things. Long-term bond funds are actually the riskier of the three, and short-term are the safer. Now, at first it doesn't make sense, but then when you think about it, oh yes, when you're lending people money, if you're only lending them the money for a year or two, there's a whole lot less probability that things are not going to go so well. But if you're lending money for 15, 20, 30 years, there's plenty of time for things to go badly. So, and this is why, if you're familiar with mortgages, if you get a 30-year loan, you will pay a higher interest than if you get a 20 or 15 or 10-year loan, just because that's part of lending. The longer the money's out, the more interest the lenders are going to want to expect, they're going to want to receive from their investments. And so the same thing happened in the bond world of mutual funds. We pick one from column A and one from column B and one from column C, and we have a domestic long-term high-yield bond fund. So not only are there dozens and dozens and dozens of stock funds, there are dozens and dozens and dozens of bond funds. See what you're up against? But you're going to study, you're going to look at that study guide, you're going to know these, and you're going to be awesome. Because remember, your friends and family and coworkers are counting on you. And so am I. And I know you're going to do well. Now, the next category is balance funds. Wait a minute. Balance funds, the objective is to generate a balanced return of both current income and long-term capital gains. They invest both in stocks and bonds. So shouldn't they be in between stocks and bonds? Shouldn't they be less riskier than stocks and more riskier than bonds? Well, theoretically, no. Theoretically, no. And why is that? Well, we're going to discuss this much later on. When you blend stocks and bonds, you wind up theoretically, now it doesn't always happen in practice, with an investment that is less risky, as defined by the risk in our world of getting the return that we expected we were going to get. And that's because stocks and bonds often go in opposite directions. So balance funds are awesome funds for people who are really, really worried about falls in the stock market. In fact, they're wonderful alternatives for people once they retire, because we're living far longer and you might be living 20, 30 more years in retirement. So you still need some growth. You want a little bit of stocks, but you also don't want to fall 50, 60, 70%. And typically, a bond fund will be 60% stocks, 40% bonds, but the allocation can change as the investment environment changes. Now, one of the nation's oldest and most successful balance fund is called the American Balance Fund. How's that for a generic name, right? And in the prospectus, they tell you this fund is managed as the complete U.S. investment program of a prudent investor. In other words, folks, we want to invest, yeah, but we don't want to lose the money. That's a fancy way of saying we're going to do our best to do capital preservation. And notice, they will never be more than 75% stocks or 25% bonds. And they will never be less than 50% stocks, 50% bonds. So they will keep that balance. They'll keep that balance. No matter what happens, you know you're going to have some bonds and some stocks. Of course, it has to be trickier, right? Because there are funds called asset allocation funds, which are lumped in often with balance funds, but they are not the same. Here we go again. A subtle distinction that is important for you as rising investment gurus to understand. These are mutual funds that spread investors' money across stocks, bonds, and money market securities. In other words, short-term cash instruments. They're very similar to the balance funds, but the investment advisor often more diligently tries to fine-tune the allocation as market conditions change. Whereas in the previous slide, a balance fund will stay 60-40. Notice the one balance fund we looked at will never be more than 75% stocks, 25% bonds, never be less than 50% stocks, 50% bonds. An asset allocation fund might try to move money into cash when they thought the market might fall. So you see, they might say, we think the market's going to fall. Put everything in cash. Or we think we put everything in the bonds right now, or put everything in stocks. And so this is sometimes called tactical allocation. I hate that term. For all their hype, the returns of many asset allocation funds are very close to balance funds, but some trail balance funds considerably because they time the market badly. And one of the best examples was at the end of 2002. It was a bad 2.5 years between March of 2000 and October of 2002. The market fell basically 50%. NASDAQ fell 80%. The technology world. And I was talking to the gentlemen who were introducing our new 403B plan at Southwestern College, and they said that their asset allocation fund was totally in cash. And I knew, okay, because I know these people are idiots. I already had determined that. That means the market's going to come back. Right? And I was right, because everybody was these people who were dum-dums were in cash because they had said, no mas. We believe the market's going to fall even more. And they were right it fell for a little bit, But then in March of 2003 is when it started its 5-year march until 2008. So I'm not a big fan of asset allocation funds. That doesn't mean you're not going to find one that suits your needs, but stick with a balanced fund, okay? Yeah. Remember, everybody has an opinion, and mine are always correct. Slide 50. The last category, money market mutual funds. Well, this is review because we've already discussed money market mutual funds, remember? They invest in short-term money market instruments, much the same as money market accounts and banks, except what's the difference? Credit unions, banks are guaranteed, whereas money market mutual funds are not guaranteed, but they're pretty darn close. We already talked about this. They are essentially as safe as guaranteed money market accounts since they invest in exactly the same securities, but they're not guaranteed. Research breaking the buck, because that's what happens. They go from $1 down to 99 cents, and when they do that, the whole world stands up and takes notice. And then what happened in 2008, I described this to you in chapter 1. The Federal Reserve Bank came in and on their white horses and their knights in shining armor and saved the day. And so, yeah, you don't have to worry. There are categories of money market mutual funds, general purpose, government securities that only invest in treasury bills. And there are some that actually invest in municipal securities, which are tax exempt. Now, how do they do this? It's a little tricky, and we'll discuss this later when we get to bonds. But when you do your research, when we ask you to do some research in actually chapter 1, you're going to look at money market mutual funds, and you'll see that there are general purpose ones that are taxable, and then there are tax exempt, which are money market mutual funds. Cool? Okay, so these are the least riskiest. This is where you put your money and you need in 6 months, a year, maybe 2 years, depending on how important the money is. Your cash, as it is euphemistically referred to. So these are the most important. And now, dear students, we're going to turn our attention to some odds and ends. Slide 51. Mutual funds of mutual funds. Oh, wait a minute. You're kidding, right? You have a mutual fund that invests in other mutual funds? Well, yes, actually, these are important. We're not kidding. They are very popular now, and there's a reason why they are, because of employer-sponsored retirement plans such as 401ks, 403bs. They're called lifestyle funds, or target date, or target retirement funds, or target college funds. You choose the fund that matches your time horizon. Say your child's going to be going to college in maybe 10 years or so. So you choose the 2030 fund for their college account. If you're going to be retiring in say 30 years from now, 2050, you would choose the retirement 2050 fund. And the company will populate the mutual fund with other mutual funds to match the time horizon. See, they'll do the asset allocation for you. They will go to the buffet for you and decide what things to put on your plate. And it's usually from the same company's mutual fund choices. As the time horizon shortens, the mutual fund will change the mix of mutual funds. And some are target risk. You choose what risk you want, and then they choose the funds. Why are these things important? Well, because whenever you recommend or choose an investment for somebody, you can get sued, and you're supposed to be a licensed individual. So your company does not want to recommend anything and get sued. So the Congress said, hey, as long as you know their birthday, you know how old they are, you can put them automatically into the target retirement fund that matches their date, and they can't sue you. So the company said, great. So now when you go to a company, typically they will take 3 or 5% of your paycheck and send it to the target date fund that matches your birthday. You can opt out. You can say, I don't want to do this, but most people do because of inertia. You can add more, right? Or you can choose your own investments, but this is autopilot. And it turns out that it works. It works very well for most people because they don't even want to think about retirement. They're in their 20s. What are you talking about? That's many years from now. But now's the time to get started. Oh, well. Now, how about specialty funds? Folks, stay away from these things. They're so ridiculous. Hedge funds. Well, you'll hear a lot about hedge funds. There are, I don't know how many of them, but there are dozens and dozens and dozens of these things, hundreds. They're not legally mutual funds, even though they get lumped in with mutual funds. They have no regulatory oversight, basically. Although they become a major force, and you hear about the hedge fund managers becoming celebrities, and everybody showers love and attention and money at them. But the expenses are outrageous. Typically 2%, 1% if you're lucky, but typically 2%, which is on the high end, as we saw in the previous presentation. And they take 20% of the profits. And traditionally, they were only open to sophisticated, accredited investors. Now, what does that mean? Look it up. It means you could lose $100,000 and you wouldn't be crying in your beer. You're supposed to have plenty of money to lose. But now they seem to be available to people with 10 grand who don't really have this money that they should lose. So stay away from them. Now, that doesn't mean there aren't good ones out there. There are, but more of them are just taking your money. There are funds that actually try to make money when the markets go down. Bear funds. It's difficult because the markets go up 4 times more often than they go down. So bear funds look great when the market goes down, but they look horrible when the market's going up. There are funds that will invest in precious metals or other hard assets for you. And you better hope that it's not just lead painted gold. You can see I'm not that big fans of these things. There are actually funds that will invest in REITs for you, real estate investment trusts. Well, this is kind of a sector fund that invests in real estate. And it's not a bad deal. It's actually not a bad deal, especially if you want to be a landlord, but don't want to be a landlord. You want to invest in real estate, but you don't want to deal with all the hassles that being a landlord entails. The thing about the problem with these, in my humble opinion, is there's just not that many REITs out there. I think you do better by opening up a brokerage account and buying the shares of the REITs on your own. And of course, that involves picking individual stocks. In this case, REITs, which are legally not stocks, but they look like stocks to you and me, so it doesn't really matter. So wait till we get to chapters 3 and 4 and 5, and we'll discuss more about how to evaluate individual stocks. But it's a good choice for people who want to invest in real estate and don't want to deal with the task of buying individual real estate properties, which is not without its problems, folks, let me tell you. Okay, and then there are all these boutique funds, exotic funds, that for the most part you want to stay away from, in my humble opinion. Stock car stocks funds. Now, what do you think these people invest in? NASCAR. Yes, when you watch a NASCAR, and I have a hard time believing this, but NASCAR is the #1 spectator sport in the United States. People, 200,000 of them, go out every Saturday and Sunday and watch somebody going around the track at 200 miles an hour. And what do you see on the cars and on the jerseys and on the caps? All kinds of advertising, and those people buy those products. So this mutual fund invested in the companies that sponsored NASCAR. The Pause Tombstone Fund. Well, Pause is the name of the mutual fund company. Tombstone was the name of the fund. Oh, no. Are you serious? Yes. They invested in mortuaries and casket makers and cemeteries. Well, everybody going to die someday. And thankfully, so did the Pause Tombstone Fund. And then, folks, you cannot make this up. You just cannot make this up. There was a fund called the Chicken Little Growth Fund for people who were afraid that the sky was falling. There were funds for good Christians, the Timothy Fund, funds for Muslims. The choices are endless, and so are the fees. And again, I'm not a big fan of these. Slide number 53, socially responsible funds. Now, these are nothing new, folks. Socially responsible funds have been around for decades, but it's since has taken on a life in itself with what's called ESG, environmental, social, and governance. So now everybody's supposed to be looking at the environmental footprint that the mutual fund is having with their investments, the social footprint, the social ramifications of their investments, and whether or not the companies are well governed. The problem with these three things is that they're not really related to one another. There's a lot of moving parts. And of course, it's become very, very much in vogue. So you'll see mutual funds that say, we're the ESG such and such fund. And I feel sorry for them because it reminds me of funds that come out when the latest new great thing comes out. The good mutual funds that have been around for decades will have already thought of the environmental consequences, the social ramifications, and the aspects of governance of the companies they invest in. But be that as it may, socially responsible funds have been around for decades. It started with some funds back in the 30s, folks, that refused to invest in companies that sold alcohol or tobacco. And then by the 1970s, they were funds that refused to invest in companies that polluted, build weapons, nuclear power plants, destroyed the rainforest, and then the companies that exploited labor. It's surprising there are any companies left to invest in, but silliness aside, many socially responsible and ESG funds have done well for their investors. Now, why is that? Well, typically, tech companies don't have these pollution and weaponry and destroying the rainforest. The tech companies, which have done well over the last 30 some odd years, are often well represented in socially responsible funds. And of course, they've done very, very well. And possibly as a backlash to socially responsible funds, there are now socially irresponsible funds. You can't make this stuff up, folks. There's a mutual fund called the Vice Fund. And yes, you've guessed it. It invests in tobacco and alcohol and all the other corporate nasties you can think of, gambling defense firm. They've changed the name a few times, and it's still a very small fund with high annual fees. But it's managed to stay afloat since 2002, so we'll see how they do in the future. But what happens when you have a very small fund, the fees become a bigger part of, because it costs money to run a fund. And the bigger your mutual fund is, the more you can amortize, which is a fancy word of spread out the fees over the total amount that you have invested. Well, when you have a small fund, the fees tend to be large because it's a bigger percentage of what's invested in the fund. But hey, check it out. Maybe you want a socially irresponsible fund. Slide 55. We're almost done, folks. Just come on. Stick with us. I know. When is he going to stop? Okay. Morningstar. For decades, there was a company called Lipper that was the go-to people for researching mutual funds. And then Morningstar came out, and they sort of, tried to jazz things up. They created this style box to help investors identify investment alternatives. And of course, they were jumping up and down, saying how wonderful these things are. And so notice what they did. They said, we're going to have large, medium, small for the stocks. They did the same thing for bonds, but it's a little different. So large companies, medium companies, small companies, and then whether the company is a growth company or a value company, and we'll discuss that later in chapter 3, or is it a blend of growth and value? And so they created these 9 style boxes. And investors somehow thought that they had to have a mutual fund that covered each one of these style boxes, which of course incentivized, motivated the mutual fund companies to come out with a mutual fund that was in each one of these boxes. And once they realized that what they did was kind of counterproductive to prudent long-term investing, they changed them to ownership zones, which they say they're even better. Okay. When you do your research and you go to Morningstar, you'll find the new ownership zones on the portfolio tab, And if you go to finance.yahoo.com, they license the old style boxes from Morningstar. So I don't use these things at all, in my humble opinion. But everyone's different. That's why there's chocolate and vanilla, and some people like strawberry. And finally, I saved the best for last, folks. As of July 2021, here were all the categories and subcategories and subcategories that Morningstar had on their website. All, 61, I think I remember the number, or 70 or something like that. No one's going to ask you, dear students, to memorize, to have all these in your head. The important thing to know is the big categories that we've outlined in this presentation. So again, I warn you, I'm going to ask you on the exam, but more importantly, you need to be able to start scratching the surface, because that's all you can do with just these major categories. You can just start to scratch the surface, and then when you find a fund that piques your interest or somebody's asking you for help, you can then dig deeper and say, oh yeah, this is a true capital appreciation fund that goes everywhere, paints with a broad brush, and looks for companies that may be growing, or the industry may be shrinking, but they're growing inside that industry, or there's a potential for a rebound because it's out of favor. Oh yes, this is a high yield bond fund, and you know what, your sister-in-law or whatever, it's pretty dangerous. You might want to buy a little bit of it, but don't make it your main choice, because it's kind of like a stock fund. They go up and down like stocks, and they're very risky. If you want something that's more moderate and more conservative, you're going to want to look at a more mainstream, middle of the road bond fund. You see? Because you're rising investment gurus, dear students, and it's a very important responsibility that you're going to have with your friends, family, colleagues, and who knows, it might become a career for you. We certainly hope so, because the industry needs you. We need more women, we need more minorities, bilingual speakers, veterans. They love ex-military. And there's a lot of us old white guys who are about ready to retire or die. And so the industry needs you. Go back and study this, folks. I know you didn't get it all in the one presentation. Some of you did. I mean, the lucky people who are really good, have good memories and the like. But everybody else, us rest of us, we have to study. In our next presentation, we're going to discuss briefly the current controversy of passive versus active management of mutual funds. So thank you so much for being in our class. I told you it's going to be less than an hour. We're so proud of you. We're so happy and honored that you're with us.